afternoon, everyone. I'm Stacy Scott, and I'm the Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'll be hosting today's webinar. Thank you so much for joining us today. Graham is going to address the elephant in the room, if you will, and talk about some current market conditions, including some market volatility, recession, inflation, and some other hot topics that are most likely at the forefront of our viewers' minds. As always, there's going to be a Q&A session at the end of the discussion. So please get your questions ready and put them in the Q&A section of the chat box. And then I'll make sure that Graham gets those questions and he can provide the answers for you. And just a reminder, Graham's calendar will be popping up from time to time throughout the presentation. If you would like to schedule some time to talk with him within the next few weeks, please click on that calendar when it pops up and select the time and day that work best for you. And now I'm going to turn things over to Graham.
Hey, thank you, Stacy, and truly thank you all for being on the call. I think you don't need me to make this statement that obviously this is stressful, anxious times that we're in the middle of. So we want to start out the call and say, as we go through the numbers and we talk about the past and we compare it to expectations, keep in mind that we're with you every step of the way as we march through this, and I say through this environment to much more prosperous times. Also, I do want to extend out our deepest condolences for the shooting victims in Texas. I don't think we'd be remiss if we didn't say that it's absolutely horrible and it's time to do something about it. But our thoughts and prayers are with everyone. But let's go ahead and jump into the call. And Stacy, I really made the statement that it's an elephant in the room, right? It's a wall of worry. What are the major issues that we're dealing with right now? And when I'm talking about major issues, it's not just the market, but we're talking about the market because that tends to affect us the most. It also is our home, it's our investments with 401ks, it's our own personal investment plans. But if we call the wall of worry, so these are things that we're going to address. We've highlighted a couple, spend some more time on in the webinar. But we're looking at market volatility. We'll look at interest rates. We'll talk about the Ukraine war, consumer demand, or maybe the lowering of consumer demand potentially here, not just today, but in the future. Recessions, inflation, valuations, and stagflation. This seems to be a lot of concerns that we have in the market. So as I say, it's a wall of worry. There's a lot of things to be concerned about. But as we address these concerns, there are bright spots and there is an end to all this. And we sometimes need to step back a little bit, have a vision and a view that is longer than 6 months, 1 year, 1 quarter, or 2 quarters, and know that this too shall pass. But it doesn't lighten up or it doesn't alleviate the pain that we're going through right now. So you'll notice in the background, Stacy's awesome about, and my team is awesome about loading these pictures in. You probably heard me before talk about the war. We're in the middle of a war, right? So think about a war, and at least in my horrible analogy here, I'm thinking about a war as something that is long-term in focus, all right? Your time horizon. And when we're thinking about your time horizon, you're going to have many battles that we're going to go through as we go through your personal war in terms of your time horizon in your lives. So the way that I would want everyone to really think about this, and maybe I'll bring it back up, listen, this is a war, this is a marathon, not a sprint, and we're having a battle right now that we're having to address. But when we're in the middle of the war and this subsequent battle, this is not the time to make dramatic changes. If you've done your homework up front, we've done our homework up front, this is the time to make adjustments and tweaks as needed, but not massive changes, because that right there, too much activity can be worse than not doing anything at all. All right. So we just want to be careful that we don't overtrade, we don't overthink, and we just, at the end of the call, I'm just going to reiterate high quality investments, diversified portfolio, and we should get through this. but it could be a bit more painful before we get to the pleasure. All right. So now that I got that out of the way, let's jump in and dial in on a couple of these areas that we see a part of our wall of worry. So if we're looking at market volatility, again, let's pull up some perspective. If you've been on previous calls, I didn't think there was any reason to reinvent the wheel. Let's go back and see what history or what's happened in history, right? And see if that might have some rhythm to it or give us some clues on what to expect now and going forward. And I think it does. Again, this isn't a crystal ball. There's no exact science. There's no guarantee that history will repeat itself. But again, I do feel that it has some rhythm. It has some rhyme. And if we think out more than a quarter, 6 months, and 1 year, this too shall pass. I'm sure there'll be something else that we'll be concerned about in the markets, so on and so forth, going forward. Well, let's think about bear markets. There's been 26 bear markets. Let me define a bear market. A bear market is a drop of 20% or more. All right. So in the indices and individual stock, real estate, a drop of 20% or more. We've had 26 bear markets in the S&P index since 1928. Right. So they're not unheard of. However, we've had almost 27 bull markets. So it's almost about a 50-50, right? Over that time frame. The average length of a bear market of 20% pullback or more, it's been about 289 days. That comes out to about 9.6 months, and that's a little bit peak to trough. Now, some are going to be longer, some are going to be shorter. It depends on what it's coupled with, right? But there is an end. I guess that's where we're getting to. And think about this. Bull markets are significantly longer. They're about 991 days. Tremendously longer than bear markets, averaging about 2.7 years. Stocks lose roughly, on average, in a bear market, about 36%, but in a bull market, they gain about 114%. So I'd say within our battle here, so we have a secular, bear or bull market that is decades, so on and so forth long. But within that period, we might have short-term bear market periods. And I think it's pretty obvious. We're in a bear market period. The indices are telling us, right? I'm probably preaching to the choir here. I fully understand my audience. But you know what? The Dow's down roughly about 15%. Dow Jones Industrial. The S&P's down about 20%. I'm rounding numbers here. The NASDAQ's off about 30%. So are there odds that we could go lower before we go higher? Absolutely. But just keep in mind, there's no flag that waves here when we've hit a bottom. There's no flag. There's not going to be a clear statement that we've hit the bottom. We're starting to bounce off. So, keep in mind that a bear market, we might pull back. We might go a little bit lower before we set ourselves up to go a little bit higher. But they do end. If we think about the odds are, so let's look at this. So over the last 92 years in history, right, we've had the market or stocks positive 78% of the time. They've only been negative roughly 20.6% of the years. So, if you're a numbers person, if you're an odds person, those are pretty good odds, right? I think the market overall past 92 years is up 85% of the time. So look at this 1 year period. We saw a positive period, 66 out of that. Only 25 negative periods, so a positive 73% of the time compared to 27. If we look over a 3 year period, that's 83% compared to a negative 17%. I think you're getting a kind of a trend here. 5 years, 87%, negative 13. But look at this 10-year period, 94% compared to 6%. Now, this is the way I would think about it. We're going to talk about time horizons. When do you need money? How long does it need to last? So on and so forth. So you have multiple time horizons that we need to be addressing. You need to evaluate, as we're working with you or you're working with someone. You want to evaluate when your first time horizon is. Maybe that's a short-term purchase. Maybe it's a car. Maybe it's college for the children. Then we think about the long-term time horizon, right? How long does my money need to last in the next stage of my life? Let's call it retirement, right? Or whatever title you want to put on it. So that's got to last 25, 30 plus years. Well, that's a lot longer than 1 or 10 years, right? So the odds are we don't want to get caught up in the short-term pain that affects our long-term gain, right? So again, it's a marathon. It's not a sprint. I'm not trying to take the pain away from you. I'm not trying to take the pain away from us. No one likes to have a down market. No one likes to see their investments down in the portfolio, right? So let's think about a recession, right? I mean, obviously that's front of mind, not just the pullback in the market. You know, we've had 26 bear markets since 1929, but only 15 recessions. So not necessarily does a bear market lead to a recession, but it does have slowing growth for the economy, right? So keep in mind, a recession is basically 2 negative quarters of gross domestic product, all right? So that would be the US economy. So we're coming off extremely high propped up periods of US growth. Is it likely that we could go in a recession? Of course. We could easily be already in a technical recession, but that doesn't mean it's got to be a deep or protracted recession, right? So there are varying degrees of recession. We're not even talking about a depression like 2008, 9, or 1929. In those periods, which are not recessions, those are deep financial collapse of the monetary system globally, all right, not just in the United States. In those periods, in 1929 was about a decade, peak to trough. We saw about 4 years back in 2008 and 9, but I don't think that's in the cards. But sure, we got to expect recessions. They're going to happen. And the average length over time of a recession is 15 months. But I think this is a pretty interesting stat we pulled up the other day. You know that the S&P since World War II has had 12 recessions, and the return, right, after we've gotten through it, right, you got to get through it, has been a positive 2%. So look at those periods. So in 1945, right, to 10/31, 1945, we saw a positive 16%. But if we go over here and we look at 2007 to 2009, you know, we were down 28%. But that doesn't mean at that particular time, at some point, that you might not have the indices go lower. It just is after we started to recover, after where are we at with the indices, so on and so forth. All right. So a positive 2%. So there's an end in sight. We know there's some positive returns at the other end. We just got to ride it out. Right. And again, it's not always comfortable, but it's something with a very thought out plan and some emotional stability, which I know it can be tough at times. We can ride this out. Now, if we jump into inflation and we think about interest rates, think about this. Inflation has been, you know, arguably way too low. I mean, over the last 15 years, inflation has averaged about 1.9%. Now, obviously today, inflation is really high. It's 8.5%, right? So we got really high inflation. You know, if we look at certain sides of the market, from groceries to gas, you know, we could throw numbers out like 15%. We could throw out 20+%. You know, travel costs, so on and so forth, are up. But yeah, inflation's high. It's not transitory, meaning, yeah, it completely. It's not going to come right back down to 1.9%. I don't know if it's going to ever come back down to 1.9%. You know, that might have been artificially low. You know, what if we take the next 6 months, 1 year, a couple years, and maybe cut inflation to half or more, and maybe we stabilize around 3 to 4%. And again, I know that's still high. That's higher than 1.9, but not necessarily has that always been a bad thing. Again, I'm not talking about 8.5 today. That is not comfortable, but we do feel that is moderating. We do feel that's peaking a bit. We're seeing a turn, say, for example, in the used car market that's been on fire. We are seeing those prices come down. We're probably going to see home values come down, consumer demand, some earnings come down and moderate a bit. Doesn't mean they have to collapse, just moderate a bit. So we think we're going to be getting some inflation here as we roll into the Fed numbers over the next couple of quarters. Doesn't mean the Fed's not going to still raise interest rates. They still, because they're behind the curve, they still need to raise interest rates. But that's not a bad thing. Think about this. If the Fed is raising interest rates, that's a vote of confidence, not just to bring down inflation, because you don't have inflation if you don't have demand, right? kind of go hand in hand a little bit. So 10-year inflation expectations, above 2.7%. Do you know the economic growth average was 3.5% on an annualized basis? So when we get inflation up, right, but not at 8.5, mind you, but when we have inflation elevated, that tends to be a vote of confidence for the economy. That's why we see earnings growing, because demand is there for goods and services, inflation goes up. So just because we have higher than average inflation, meaning maybe higher than 1.9 that we've seen in the last 15 years, or even above 3 long-term trend, doesn't mean that's necessarily a bad thing. It actually can be a vote of confidence. So interest rates going up to bring down this high level of inflation is natural. It has to happen. Doesn't mean we run for the hills, but it is causing some anxiety in the market. That's obvious. It does increase borrowing costs. It does erode demand, that high inflation. So we're seeing that all come together right now, right? But again, it doesn't mean a collapse. We really do feel it's going to be a moderation, right? If we now think about a war, and we brought these slides up before, and a war is horrible. Absolutely no positive in this situation, right? Both sides are going to lose, and then unfortunately, everyone's going to have to pick up the pieces. But from a commodity standpoint, from an anxiety standpoint, yeah, it causes a lot of damage, right? So if we go back to World War II, the median market sell-off was roughly about 5.7% when we've had these geopolitical shocks. During the 2 worst wars in modern history, the market was up 115%. And during Vietnam, the S&P gained about 29%. Now, we have more than the war going on, right? We knew going into this year, if we wanted to realize or not, we knew that there's going to be a moderation in demand. We knew there was going to be stubbornly high inflation. We knew at some point that the prices, the cost to the consumer was just going to be too much to bear, and they're going to have to pull back to some degree. But as long as we have a strong unemployment rate, which we do, we have a strong employment rate right now. If you want a job, you need to get a raise, you know what? Go ask for it, because the odds are you got a job, and the odds are you can get a raise. Now, I'm not saying anyone in my office needs to come running to my office after this call today, but yeah, it's a very strong market. As long as, and that might moderate a bit, but as long as we have a relatively strong market, which we still feel like we are, we feel like we're going to have demand there, even though it's going to moderate, which affect corporate earnings, which again puts pressures on stocks. But listen, the S&P is still down 20%. NASDAQ's down 30%. Some stocks are down 50, 70, 80, 90%. Some are not going to come back, right? So we already are seeing the damage done. So what do you need to know, right? First off, I think about it this way. Before you can figure out how to manage something, you got to understand some basics. You have to know your goals and objectives. We're working with our clients. We have to know our clients' goals and objectives, right? What is your retirement income needs, for example, right? How long do you need that to last? Is it putting Johnny and Mary through college? Is it paying for a car? What is this for? What's your time horizons? I'm a big believer there's not one time horizon. There's multiple time horizons. Multiple time horizon on when you'll need funds for, say, college costs or a purchase of a car or a repair on a house. Maybe it's a time horizon for retirement, which we know averages probably 25 to 30 years in retirement. We're managing retirement planning in terms of stretching out income streams that our clients never have to worry about, right? And isn't that peace of mind? You never have to worry about the income you receive. So you don't have to worry about the stock and bond market and its performance. You got to think about it. That's lasting 20, 30 years, but we're planning to the mid-90s now. If you have anyone in your family tree that's made it to the 90s or 100, you know what? We need to be planning for that, And I would say at the end of the day, if we come out, you got more money than you ever need, all right, we'll apologize. I don't think we've ever been fired over that, at least not yet, right? Then when you think about your risk tolerance, and I know we talk about this a lot, bless our clients on this call. You know, we always bring this up and up and up because we really want to put as many tools in place ahead of time. So when we go through these periods of volatility, anxiety, these really uncomfortable periods, we have an expectation of what our portfolios could go down, what they could rise. So when you go through it, I'm not saying you got to like it, but you know, and then we can always make good emotional decisions instead, good business decisions instead of emotional decisions, right? So we have a good understanding of risk and risk tolerance. And last but not least on this slide, I do want to make a point. Everything has risk, right? And we talked about that many times. You got market risk. As the markets go up and down, so are investments, stocks, bonds, real estate, so on and so forth. You know, we got company risk. How well is the company going to be able to perform, right? Currency risk, inflation risk, interest rate risk, opportunity risk, liquidity risk. Everything has risk. We got to define the risk, define what you're comfortable with, and make sure that's a part of your planning strategy, which is what we do, which is what we've already done, all right? When we get into having a plan, right? How are we going to manage through all this? We're going to manage through this just like we always do. Do we need to make some small adjustments and tweaks? Absolutely. But when you're in the middle of that war, you're fighting your battle, this is not the time that we want to change completely everything, unless something fundamentally says we have to do it because of you. But you know what? Even though we have a change in the market from growth to value, in terms of expectation, what will perform and not with stocks, bonds, and etc., you know, we just make adjustments. We make some fine tweaks, because if you do your homework at the beginning, we do our homework with you at the beginning, which we've done, we shouldn't have to, right? But adjustments are always going to be necessary, right? So the phrase around here, boring is beautiful, right? We love boring, right? And I hate to say that, but there's a growth strike going on. And when I say that, anything that got us through the pandemic, that made our lives or gave us the ability to work from home and have this hybrid lifestyle to protect us, so on and so forth, those valuations were too high. You know, the consumer demand for those goods and services are waning. The valuations are too high. So the market is saying, hey, listen, we're not going to pay up for that. We're pulling those valuations down. That's why it might be a great product, it might be a great service, but the valuations are too high. So there's two things. You look at a product, a service, you got to look at valuations, right? So when we think about that, we're seeing a strike on growth. I mean, the market is not accepting growth at any price. It wants growth at a reasonable price. We've brought that over and over and over again. Again, boring. Diversify into stocks. Cash flow. Let's make sure those stocks that we own, those equities that we own within the managed products like ETFs, funds, or individually, make sure they're comprised of companies that have obviously solid products and services. They got great cash flow that's hitting the balance sheets. Let's make sure, hey, if it's got a dividend, let's try to get that above the 10-year treasury. I think that's a good starting point. So you can get paid to wait. If you got to wait for the stock to be down, at least you're getting another revenue stream, right, in that investment. And then share buybacks. You know, that's companies putting the money where their mouth is. They're buying shares, taking them off the market, lowers earnings per share as long as the earnings per share is stable, right? Think about quality, upping the quality, right? Making sure they have the above statement. We want solid earnings, solid products, solid management, dividends, buybacks. Increase your personal cash reserves, all right? So when we're thinking about what should you do, right? Well, if you were kind of riding the line a little bit, make sure you got that 3 to 6 months in emergency funds. You know, why not make sure that you've got that 1 year of income you need set aside in a low yielding, but money that you can get your hand on that's not tied to the stock market, right? I think now is not the time to take too much risk, but it is not the time to not take risk, because everything has risk. We just got to define what's appropriate, right? Then we think about guaranteeing income. I love the idea for my retirees, and if you're a client and you're on this call, you know we've talked about this. I love you guaranteeing your fixed expenses. Maybe you use that with an annuity. Maybe there's another product that you use. You know, annuities and insurance policy designed to pay you out an income stream you can't outlive. What we use it for might be to defer taxes. lower volatility, or to help guarantee those fixed expenses, not all your variable, but fixed expenses. So what I mean by guaranteed income? Guaranteed income sources, if you're retired, is Social Security, pensions. I would say if you have an annuity contract that's paying you out a guaranteed contractual income, that is guaranteed income. And I love the idea of using or considering using products like that to guarantee your income stream. Can be used a little bit to lower volatility, certainly can be used for tax deferral. Value over growth continues to be a theme that we're leaning in. I'm not going to say that valuations aren't getting stressed in utilities, staples, not necessarily all commodities at this point. I think energy is still relatively low based on the earnings projections and the high valuations that we're still going to see for those commodities. Real estate, maybe gold, silver, things like that. I'm not telling you load your portfolio up in these things, because keep in mind, everyone's going in that direction. And there'll be a time when they got to move away from that direction and go to growth. But I still think growth, value over growth. But I don't think you don't have growth. We just want high quality growth, right? With earnings, solid products, profitability. I know that's crazy, profitability, right? So value over growth, you can look at those areas, but just keep in mind, it's a pretty crowded trade. I'm not saying don't own it, but don't be scared to take a little profits over time. But again, these are things you got. If you're not working with us, you need to be having a conversation with your own advisors, all right? It's a case-by-case situation here, all right? But we're still very much leaning in that area. We don't recommend taking any unnecessary risk in this market until we can get some stabilization. There'll be time enough to take a lot more risk, right? So we just moderated it a little bit. Stacy, how about we open this up to some Q&A since we got a little bit of time left?
Absolutely. Well, you may remember that when we were preparing for today's call, we kind of thought that one of the questions that would come in would be this specific question, and we were right. I mean, we should have placed a wager on this because we were right. Should I get out of the market and just buy back when it hits the bottom? Mm-hmm. And we prepared a slide because we were so sure that this was going to be.
We don't get these calls, right? Listen, I think it's tempting, right? I mean, it's certainly tempting. It's tempting in my own personal accounts. It's tempting, to consider it for managing assets. But we know what, it just doesn't work in time. Right? It's time in the market. It's not timing the market. Even the best of the best can't get it right. Again, there's no flag that's waved, right? So let's look at, just a little thing from Bank of America we pulled up. So we looked at data going back to 1930, and they found that if an investor missed the S&P, which we're generally calling the stock market here, 10 best days in the decade, the total return would stand at 28%. If, on the other hand, the investor held steady through the ups and downs, the return would be 17,715%. What a massive difference. And because we don't exactly know, right? It might be some short-term pleasure you're getting because you're not having that pain. It's sitting on the sidelines. And I get it. That's why we say increase your cash position, but not all cash, right? Everyone's situation is different. So we need to, kind of manage that case by case. But we really think it's rather impossible. But use good diversification, keep a little higher cash reserves. That can accomplish a lot of peace of mind right there.
Okay. One of our viewers is asking, do we see this market going further down?
Isn't that a little $1 million question? Right?
Yeah.
Well, based on the previous slide that we pulled up, the average bear market, right, is down about 36%, 36%. The S&P is down 20%, the NASDAQ's down 30%. If we look at history, and history was any guide for the future expectations, then I would say we could probably expect a little more pain before pleasure. Doesn't mean it's got to be a lot more. It doesn't mean that, heck, we stay here and then we stay down on the indices, stock and bond market. I'm not just talking stocks here. And we just grind around the bottom for 6 months to a year. I was talking to a client earlier this morning, and I was like, is that the craziest thing? I mean, as we were talking to clients last year, trying to prepare for a much more challenging year, we said, listen, we know you're not going to like it. We're not going to all go to cash. Maybe we up the quality, keep a little more reserves, lower our risk here a little bit. But you know what? Maybe we do accept a pullback. Maybe we do accept some consolidation before we can build off of that to have better times. And I think that's probably what we're facing here. Maybe a little more pain before pleasure. We just don't have a crystal ball.
Okay. All right. What should I do if I'm at or approaching retirement age and I need to use some of the assets in my portfolio to live off of?
Well, just like we really said before, I want you to up that quality in the portfolio. I want you to make sure you got your cash reserves in place, 3 to 6 months emergency, and then above and beyond that emergency, and I know this might be cautious for some, this might not be cautious for some, I want you to at least, or I would like to see you at least have at least 1 year of your income needs, placed in ultra secure money market type vehicles, not at the ebb and flow of the market. Right? What type of investing you've done in your 20s and 30s and 40s is going to be different when you're approaching into retirement. So we need to, manage that. Does that mean you all go into bonds? No, there's plenty of other areas. You could look at, these are not recommendations, just points of conversation. Annuities can play a role to guarantee income, lower volatility, defer taxes. It could be looking at, different areas of the market that aren't the most traditional areas of the market for income, right? Could be looking at different style of bonds than the more aggregate bond area. So there's so many different things that I know we bring to bear with our clients in their portfolios that you can do for your own.
Okay. Well, thank you so much, Graham. It's been, I think we can all agree that it's been quite a roller coaster ride the past several weeks, and it's good to have this advice and your voice of reason here. And as you all know, we do host a weekly wrap up every Monday to just kind of give a brief rundown of what happened in the market the previous week. So I'd like to invite you all to join us weekly for that, and also continue to check us out on social media and our website, where we post the latest and greatest information that we have out available for you. And as always, thank you so much for joining us for our monthly Lunch and Learn, and we'll be looking forward to seeing you again next month. And in the meantime, hope everyone has a great weekend, a great holiday weekend, and we'll see you next month. Thanks so much.
Take care.